More Canadians are falling behind on their mortgage payments than at any other point in the last 13 years. And the province getting hit the hardest is right here in Ontario. Ontario's mortgage delinquency rate has more than tripled since 2022, and it just crossed the line to be above the national average for the first time on record. Toronto's rate is up 60% year over year, and we haven't even hit the peak of the mortgage renewal wave that everybody's anticipating in 2026. Over 1 million more mortgages are set to renew this year. So what does this mean for us in Ottawa? Are we heading down the same road as Toronto? This is exactly the question that we're going to answer in today's video. First, a quick definition. A mortgage delinquency means that you're at least 90 days behind on your mortgage payments, 3 months of not being able to keep up with your mortgage. According to CMHC's Fall 2025 report, Canada's national mortgage delinquency rate sat at 0.22% as of the second quarter of 2025. That actually came down slightly from the quarter before, the first drop in 3 years, which sounds like good news. The catch here is that the national drop was driven largely by improvements in Atlantic Canada, Quebec, and on the prairies. Ontario and BC went in the other direction. Ontario climbed to 0.23% above the national average for the first time since CMHC has been tracking this in 2012. And in 2022, Ontario's rate was 0.07%. So we've gone up from 0.07 to 0.23 in that time. That's more than a 200% increase. Toronto is even worse at 0.24% as of Q2, up 60% in a single year. And it's not just mortgages. 1.45 million Canadians missed a credit card payment in Q3 of 2025. Ontario leads the country in non-mortgage delinquency as well at 1.8%, up over 20% year over year. As Equifax puts it, mortgage payment shock is cascading into missed payments on credit cards, personal loans, and even on the mortgages themselves. In my opinion, non-mortgage debt payments are a canary in the coal mine for an upcoming wave of missed mortgage payments. People are normally going to pay their mortgage before their credit cards and that sort of thing. So we know what the national, provincial, and numbers in Toronto look like, but what does this mean for Ottawa? And here's the number that matters most. As of Q3 of 2025, Ottawa's mortgage delinquency rate is only 0.15%. Ontario as a whole, again, is up at 0.24%. Toronto is at 0.26. So Ottawa is sitting at a little more than half the delinquency rate that we're seeing in Toronto, as well as being below the provincial average. In fact, CMHC specifically called out in their report Ottawa, alongside other cities like Winnipeg and Halifax, as markets seeing smaller increases in the amount of mortgage arrears. And according to a Globe and Mail report citing CMHC forecasts, Toronto arrears are expected to climb to 0.34% by the end of 2026 and keep on rising from there. By contrast, Ottawa is expected to peak around mid-2026 and then start to decline. Now, this is only one opinion in the Globe and Mail, but this is a really important distinction. We're definitely not immune to what's going on here, but the trajectory is very different in a positive way for Ottawa. All that being said, we're obviously not completely in the clear here. The Fraser Institute found that in Ottawa-Gatineau, the monthly mortgage payment on a typical home takes about 50.4% of the median after-tax family income. Now, that's way better than places like Toronto, where this stat is actually at 110%. No wonder people can't afford things in Toronto. But it's still over half of your take-home pay for the average household. That doesn't leave a lot of room for things to go wrong or payments to go up. Now, there's a few key reasons why Ontario is getting hit harder than the rest of the country. And the first is the mortgage renewal wave. People who locked into low rates, like in the low to mid 2% in 2020, are now renewing at close to 4% or higher. On a $500,000 mortgage, that's roughly an extra $600 per month. And over 1 million of those mortgages are renewing in 2026. And the Bank of Canada has said about 60% of the renewing households will face significantly higher payments. Second, Ontario and BC have the most inflated prices during the pandemic. Bigger mortgages mean a bigger payment shock at renewal. The third factor is job losses. A CIBC Capital Markets report found that delinquencies so far have actually been driven more by job loss than by any sort of payment shock. And this isn't just for households. Equifax's Q3 2025 business credit report shows Ontario's small businesses leading the country in financial trade delinquencies at 3.86%. And that's over a 10% increase year over year. When businesses are struggling, that means job losses, which circles right back to people's ability to pay their mortgage. And the fourth and final problem is the investor problem. A lot of people, this is more of a thing in Toronto than it was in places like Ottawa, but a lot of people bought condos during the pandemic planning to flip or rent them. Carrying costs are now significantly and pretty suddenly higher. Rents don't cover the mortgages and prices have dropped. These investors are underwater in a lot of cases, and many of them are just walking away from pre-construction projects. CMHC has flagged this as a key driver of delinquency, specifically in Toronto. So who is this actually going to impact? Who needs to be concerned in Ottawa? People who bought at the peak in 2021 or 2022, particularly with a fixed rate. Your renewal is coming, and if you haven't talked to your bank already, you really should, because there's a decent chance your home is worth less than what you paid. If your finances are tight, better to be proactive now. People who are stretched thin financially are also at risk. If you're having trouble making ends meet before your renewal hits, you'll need to start preparing immediately. And obviously, condo investors whose units aren't as cash flow positive or worth as much as they thought they were going to be are at risk. Ottawa's condo market has a lot of inventory right now, and the prices are softening as a result. If you're relying on values to go up in order to make that math work, the market is not going to cooperate with you, at least in the short to medium term. And the final at-risk group here is younger Canadians, who just seem to have been getting screwed over the last decade or so. People aged 26 to 35 have the highest non-mortgage delinquency rate at 2.45%, and that's up 20% year over year. So if you're in this group of younger people and you're considering breaking into the market, it's not to say you shouldn't do it, but make sure that the math works. This is not the time to overextend. Now, this is not all doom and gloom. There's a lot of people who are going to be just fine. If you bought something that you can actually afford and you're in a good location with stable employment, you're gonna weather this and be completely okay. Ottawa's delinquency pressure is expected to moderate and be temporary, not the sustained increase that places like Toronto are facing. Now, if you're in one of these at-risk groups or are just kind of wondering what you can do to mitigate your risk to this sort of thing, one is talk to your mortgage broker now if a renewal is coming up. Not your bank, preferably a mortgage broker, because the mortgage broker is going to shop around on your behalf. The first rate you're offered at a bank is almost never the best, and good negotiating during this period can really save you a lot of money. So unless you know what you're doing, go with a broker to do that negotiation for you. Number two is to start adjusting your budget before the renewal hits so you get used to it, not after the new payment shows up. Extending your amortization is an option as well if you absolutely need the cash flow, but understand that you're going to be paying more interest in the long term, and it's going to take you a longer period of time to pay off your mortgage if you do this. Three, if you're buying in this market, it's actually working in your favor. More inventory, more negotiating power, but make sure you buy with a buffer. Don't buy at the top of your pre-approval so you're protected in case prices go down or rates go up. And the fourth and most important thing you can do is watch the data, not just the headlines. The three numbers that matter the most are Ottawa-Gatineau's unemployment rate, months of inventory in the market, and specifically the market segment that you're looking to buy in, and the mortgage delinquency rate that CMHC publishes quarterly. If these stats move in the wrong direction together, that's when you're going to need to be more concerned and maybe put a stopper on your plans. So yes, delinquency rates did go up, but the national rate did come down for the first time in a few years recently. Interest rates have been trending downward. The Bank of Canada cut its benchmark rate from 5% to 2.25 over the last couple of years, and CMHC forecasts Ottawa's arrears peaking in mid-2026 and then declining. This is a temporary pressure point in Ottawa specifically, not a long-term trend. Canadian borrowers have also proven to be pretty resilient. People are extending amortizations, shopping for better rates, and finding ways to make it work. It's not easy or comfortable, but people are going to get through this for the most part. If you've got a renewal coming up or you're thinking about buying or selling in Ottawa, I'm always happy to chat. There's no obligation, no hard sell here, just good information. If you've found any value here, please consider liking and subscribing so this video reaches more people who might need to hear it. And if you've been through a renewal recently or have questions, please drop a comment below. I'm really curious to see where people are at on this. Thanks so much for watching. Have a wonderful rest of your day and take good care.